Welcome to the Amateur Investor Tool. The purpose of this video is to guide you through the features included within this tool. Are you an amateur looking to invest in the stock market? Do you want to minimize risk that comes with taking a position in the volatile stock market? If you say yes to any of these questions, this tool is for you. The Amateur Investor Tool hopes to assist you in investing in profitable stocks while minimizing risk at the same time. Let's take a look at how this tool works. Let's click here to get started. This is the main interface. As you can see, to our left, there are buttons that link to the user guide, the introduction page, and the button to download the add-in required to use this tool. For first-time users, we recommend you read the user guide to get a better understanding of the tool. This user guide explains what stock options are and why we should purchase them. If you scroll back up, you can click the Back to Tool button to go back to the main interface. The first step to use this tool is to download the add-in by clicking this button. This add-in extracts real-time stock information listed in the S&P 500 in order for our calculations to reflect the most up-to-date market data. Once the add-in has been downloaded, the user can go ahead and click the Calculator button. As you can see, a dialog box pops up which asks the user to input basic information regarding the stock they're interested in purchasing. First, the user needs to enter the ticker symbol for any company listed in the S&P 500 index. For example, for Dell, the user would type in DELL. Then, the user is asked to put in the number of shares they are interested in purchasing. In this case, we want to put in 100 shares. Next, the user will type in the number of days worth of data the model would consider in order to calculate the implied volatility of the stock. For example, we want to use 180 days. If you don't know how many days you want to put in, we suggest you put in 90 days. Last but not least, the user chooses whether they want to select short or long. If the user selects short, that means the user is interested in selling a stock but buying the right to purchase the stock back at a specified price within a time frame, regardless of what the current stock price is. Vice versa, if the user selects long, the user is interested in investing in a stock and purchasing the right to sell the stock at a specified price within a time frame, regardless of what the current stock price is. For more information, the user can refer to the user guide. But for now, let's select long. Once the user puts in all the required information, they can hit the Calculate button. The calculation takes around 1 minute depending on the computer speed to update the output table on the main interface. Once the table is updated, you can exit out of the dialog box and hit the F9 button over here to the right to reflect the updated outputs. Over here to the bottom left corner, we can review the information we entered in the pop-up box. The main table in the middle is a table that lists various strike prices and the corresponding market and model estimated option prices. Now, you might be wondering what a strike price is. Well, if you remember, we selected long, which means we want to buy the option to sell a stock at a certain price. This certain price is called the strike price. The option to sell the stock at this certain strike price is called a put. The market price corresponding to the strike price reflects the amount investors are willing to pay for the put at that specific strike price. The estimated price is the price our model believes is the appropriate value of the put based on the Black-Scholes model. If the market price of the put is less than the estimated price, that means that the market undervalues the put. The value column on the right reflects the ratio of estimated price to market price of the option. If the put is undervalued, the value is green. If it is overvalued, then the value shows up red and should not be purchased. The smaller table to the top right presents the information you actually need to know. Based on the model, it gives you the total number of options you should buy, the total cost of the options, the best strike price corresponding to the best option price, and the current share price of the stock. We acknowledge that this is a lot of information for the amateur user to take in all at the same time. So we have a step-by-step guide and the interpretation of the results written out in these scroll downs over here to the right. To the very right of the interface are two charts. The one on the top that's titled Maximum Profit Given Different Strike Prices may be useful to users who want to figure out the various strike prices given an expected return. For example, if the user wants to sell the stock once it goes up to 8%, then the best option to buy given that strategy will be the one by typing 0.08 into the expected return box and observing which total profit is the highest and the corresponding strike price. The chart below that's titled Maximum Loss Given Different Strike Prices may be useful to users who are only willing to lose a certain amount of money. The user will then pick the option that has a lower value with a downside risk capped at a level they feel comfortable with. For example, if the user has $100,000 but needs to set aside $80,000 for college, this would mean the maximum amount of money the user is willing to lose is $20,000. This chart presents the maximum loss given various strike prices that the user may refer to when deciding which strike price to buy the stock at. Overall, we hope this tool is useful for beginner investors in starting their portfolio and hedging risk to maximize return and minimize losses.